This is Trepp Wire Week in Review for week ending December 4th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, concerns over the rising COVID hospitalizations and deaths spur the CDC to issue more warnings. And overseas, the UK is the first to approve a fully tested vaccine. In the US, the Fed extended through March 4 backstop programs. And as other programs are set to expire, there is renewed hope that a stimulus bill may be within reach. Meanwhile, Americans seem to have hunkered down. US companies added fewer jobs. Travel is back to summer lows. The percentage of office workers has dropped to 18%, and consumers turned to online shopping, resulting in a 44% surge over the holiday week. Manus, we reported that the overall CMBS delinquency number was down again last month, but we see indicators of continued challenges for some sectors.
Thanks, Martha. I agree. I think that it really confirms what we predicted, or at least what I predicted. Joe was a little bit more bullish than I was.
Hey, we got a lot of time until June or July, all right?
Joe was bullish on where CMBS and CRE was going. I was less so. Just to recall the preliminary numbers we talked about last week, the delinquency number did dip just a little bit between October and November. The November number, 8.17%, which was down a couple of basis points. It was the 6th month in a row that we've seen a decline overall, which was terrific. Part of the decline, as we've mentioned many times in the past, has been helped by some forbearances, loan extensions, and so forth. To Martha's point, before retail and hotel continue to be really hard hit, we saw a very modest uptick in the percentage of loans that are in special servicing. On the lodging side, on the retail side, we saw a modest dip in the special servicing number. And on the delinquency side, lodging, after several months of coming down, reversed course and went back up. Retail saw the smallest of declines last month. So those remain the two worst segments of the market by far. The lodging uptick, not really that surprising considering that we're in now the second wave. We seem to be really in the grips of it right now. And for some loans, relief is ending, which may account for that ticking up. And on the retail side, we do think that, even with hotels, there's a light at the end of the tunnel if we get a vaccine. Retail, that light at the end of the tunnel seems awfully dim.
This week, we released Trepp's third quarter bank consortia data for CRE delinquencies and defaults. And similar to CMBS, the retail and lodging sectors are the ones with the greatest increases.
Yeah, so this is Taller, our Trepp anonymized loan level repository. I really like the name because taller is better. So lodging, retail, office. Lodging went from, this is from Q2 to Q3, and it is 30 days plus past due. In Q2, lodging was 1.42%, and in Q3, it's 3.59%. Pretty decent increase. Retail jumped from 3.09% to 5.25%. Office went from 27 basis points to 44. Multifamily actually had a decrease from 61 to 35. Industrial was relatively flat, and the rest of the universe was relatively flat. The forbearance rate was 75% in lodging and almost 40% in retail. So, these numbers, comparing these numbers to Manus's numbers from the CMBS universe, generally bank non-payment rates and non-accrual rates and those types of things take a little bit longer to actually flow through the data, and usually they're lower than the CMBS universe. So this kind of equivalent increase in lodging and retail makes a lot of sense, but you wouldn't expect that these numbers would get as high as the CMBS universe.
So now that we're in, kind of final seasons for semester one in college, this seems like the compare and contrast.
Juxtaposition, if you want a good word for your thesis.
Assignment, where you get out the blue book and you have to compare and contrast Russian literature with French literature, which I would usually kind of cliff note both. But in any event, let's start with what Taller is for those that may not remember. Taller is something we started a couple of years ago. We take data from, I think, about 20 big US banks. They provide us with their loan by loan detail of CRE and C&I loans, the same file that they submit to the regulators every quarter. They submit it to us within 45 days. At the end of the quarter, we take it, we put it together, we anonymize it, and we give it back to the banks to allow them to benchmark their own portfolio, see how they compare both on the delinquency side, as well as kind of what kind of loans they're making in terms of LTV and debt service coverage ratio and so forth. It came out of the Dodd-Frank Great Financial Crisis timeframe when people were building default models and they wanted as much data as possible. Most of these banks take our CMBS data to build credit default models, and now they also take Taller data to do the same with that. The fact that they're all going in the same direction is the compare, right? They're seeing the same areas of weakness that the CMBS market is seeing, right? Retail and hotel. The contrast would be some of the following. Banks in general, have smaller loans. Their hotel loans are probably not made up of that $150 million New York City Times Square loan, probably more community loans that support travel in their community, maybe roadside hotel, maybe a big community member that owns a portfolio of hotels. On the retail side, a lot of grocery anchored. So to the extent that grocery anchored outperforms and has outperformed the broader retail market, it makes sense that their numbers are lower than what we're seeing on the CMBS side. And there are signs that the roadside travel destination hotel has done better than the 24-hour city or something in a flyaway destination. So that trend may continue over the following quarters.
Yeah, so we have almost 200 billion in CRE and construction loans in this data set as of Q3. So it was, you're right, originally kind of going to be used for modeling and regulatory risk work and things like that. I think these days it's really something that we're building tons of dashboards and kind of as real-time indicators as you can get in terms of new origination, new volume, delinquency rates, non-accruals, and stuff like that. And it's kind of hard to get access to this type of stuff out in the universe because this is bank data, right? That's not something that banks generally kind of put out there at a granular level. So we're getting a lot of kind of interest on this side, and we are very interested when we see the data come in. It's not nearly as kind of real time as the CMBS market, but it's definitely very interesting to see. And we have, almost half of that universe is actually in kind of the New York MSA. So we have really great coverage there. So it's very interesting to see, across the different counties, different property types, how things are doing. So especially in terms of kind of new volume, because most banks, from what we heard anecdotally, were kind of in, extend, forbear, and asset manage heavy over the last 3 to 6 months or more. But to see kind of continued increases in origination is somewhat promising.
Yeah, the period for us from 2012 to 2015 was extremely busy helping these banks build models, as everybody really had to build CRE, probability of default, and loss given default models as a result of regulatory demands of Dodd-Frank. And it will be interesting to see if this crisis forces the hand of banks once again to come up with something which is a pandemic shock, right? What happens if demand just completely disappears and you have to shock your portfolios? The reason why we wouldn't do that, perhaps, is that the banks are so much better capitalized now than they were 10 years ago. So there may not be the legislative push to add more regulatory demands on the banks themselves. And it doesn't look at this point that this will become a systemic risk to the economy, CRE on bank portfolios. So that may prevent this from happening. But it is certainly would be, a good part of bank hygiene to kind of parse through this data a year or two from now and see exactly where things got hit and how badly.
Menace, last week we talked about occupancy dropping, and our team since then has dug a little deeper into what that looks like to get a better gauge of what's happening.
Well, we talked about in Trepp Wire this week 2 stories, one of which, I guess maybe we talked both of them last week on the podcast. One was the big multifamily property in Lower Manhattan, the Gary building, which we talked about, the 76,
wavy building.
Right, I think it looked like something that needed to be ironed.
Looks like my shirt.
It looks like it's a very interesting looking building. You could pull it up on Google Maps and take a look at it. It's quite interesting. It's disturbing looking the first time you see it. But in any event, we had seen a big fall off in occupancy between the end of 2019 servicer reporting and 2020. We had seen occupancy drop by about 20% or 25%. We also talked about a property in Fort Worth where it was even worse, where occupancy went from in the 90s to in the 50s over several months. And we use that as a starting point for a research project that we're going to put out over the next few days. What we looked for was the percentage of loans in the CMBS market that had seen either a dip of more than 15% occupancy between 2019 and partial year 2020, or a dip in DSCR of more than 0.50x. And we did this by all the property types. Not surprisingly, lodging has been absolutely crushed. Almost 50% of the hotels that have reported 2020 financials so far have seen dips in occupancy of more than 15%. In some ways, I'm shocked that it wasn't more. I'm shocked that it wasn't like 75%, but that's what it is. The DSCR number, the percentage of hotel loans that saw dips of more than 0.50x from 19 to partial year 2020, 2/3. So, real big distress there. Everything else has held up pretty well, and it kind of makes sense because, people are working off long-term leases, even on the retail space. So industrial and office are both less than 1.5% when it talks about occupancy dipping more than 15%. Retail, a little over 2%. So even though retailers may be threatening to withhold rent or putting in cancellations, at this point, it hasn't been reflected in falling occupancy that dramatically yet. On the DSCR side, that's seen kind of a bigger impact. Retail, almost 9%, has fallen by more than 0.50x between 2019 and 2020. But the interesting thing, and we're going to put out a spreadsheet on this next week that we'll make available to our listeners, is at this point, almost 4% of the multifamily space has seen occupancy fall by more than 15% between 2019 and 2020. And we're going to put out a list. There's some really big names in there, in addition to the Geary and the property in Fort Worth. We think it's too early to call a trend, whether this is like a harbinger of bad things to come, or maybe some would see it as, wow, it's only 50 or 60 loans at this point. This is pretty good, all things considered. But we'll let our listeners make their own judgments about that. So you can look for that next week. But we do think it's an interesting data point.
Yeah, well, that Fort Worth story really caught my eye in Trepp Wire when it went out. I think it went out on Friday last week. And because, every time you turn around, you hear another story about how everybody's moving to Texas and everyone's moving from California to Texas and all that type of stuff. Although they're probably moving to Austin. So I looked at it. It's the Parkside at So 7 SO7 in a 2015 deal, about $54 million loan and it just kind of blew my mind that how could a multifamily, I can understand how an office or a retail could go from 90 to 53% occupancy. And that's what happened in this one. It went from 90 to 53. And then kind of digging in a little deeper, it's a mixed use with, I think it's 300 units or so, but they also multifamily units, but they also have retail as well. They've got a Rue La La and a few other tenants there. So it could be kind of a mix of losing maybe one of those big non-renter tenants, multifamily tenants that added to that one.
That's possible. The Gary, interestingly, has 5 floors of, I believe, an elementary school in its building. It's a 76-story building with an elementary school, I believe. It could be a high school, but I think it's elementary school in the first 5 floors. And you wonder if that hastened the departures of people, that, they didn't want to be in a building where people are coming and going every day from all over the city to take part in school. I don't know. Or maybe that's part of the vacancy.
I was going to say, is it a private school or a public school? I don't know.
I don't know. But for listeners, we do have Trepp Wire. We do have this proprietary content that we put out every business morning. We know that some of our listeners don't get Trepp Wire. If you don't, you should. But if you don't, we make it available to our clients. But in this case, since we've talked about it so much, if you ping us, send us an email, we'll send you the story on the Gary, and we'll send you the story on the Fort Worth, Texas property. We'll share it with you so you can get a taste of what these things look like from our daily reporting.
Yeah, I did for a Twitter friend, we'll call DS. I did a quick query today or yesterday on multifamily drops and appraisals, and there's really only 1 or 2 that were of serious drops, and I think both of them were student housing and not true multifamily. So we really have we really haven't seen the cracks really surface yet in multifamily. We're starting to see them one by one here in these different stories, but we're not kind of seeing them cascade in yet. I shouldn't say yet. We haven't seen that happen. I'm not sure if it is a yet or not.
Yeah, so we'll have a spreadsheet available. I think it'll be Wednesday. If you're on our email distribution list, you'll see an email about it. You can see the loans that we've identified as such thus far in your inbox.
Turning to retail, we saw a number of stories that spell more bad news for brick and mortar.
Well, there's just so much out there right now. My computer has so many open tabs right now of things to talk about. It was very interesting. One thing that we flushed out during this week was a story on Yahoo Finance. Actually, it's a Bloomberg story that was redistributed through Yahoo Finance. I should give the credit where it's due. Eliza Ronalds, Hannon, and Lauren Coleman Lochner wrote the story. In any event, their story is that vendors are getting concerned about Belk's ability to stay viable. And that concern is because they've been getting their payments late. Sycamore, the private equity firm, is the owner of the operation. So we put out some research that discussed where Belk is both a collateral tenant behind a big CMBS loan or a non-collateral tenant. And their presence is quite noteworthy. They operate really in the southeast part of the US, a lot of Tennessee, South Carolina, Georgia, Florida, some Texas, et cetera. They have 300 stores. And if they were to really run aground, that would be just another real, kick in the teeth for CMBS investors, mall REITs, and so forth. That being said, from time to time, these retailers will just be aggressive with their vendors, just as a tactic to maintain liquidity, and that may be the case here. Belk did refinance a large term loan last year that gave an awful lot of liquidity at the time. So it may be that they're not in dire straits at this point, but just something to watch as time goes on.
We don't know anything about Sycamore one way or the other, but there is that kind of private equity reputation, right, of being kind of cutthroat on cutting costs and things like that at this stage of a company's life.
Well, we are that in that time of the year, which I hate to bring up, but historically we've seen retailers try to get through the holidays, try to cash in on one more big payday, and then come January, that's when they announce all their store closings. So it wouldn't be a big shock that come January, we see a lot of the retailers say, now that we've gotten through this season, we're going to close another 20, 30, 40 department stores, from the likes of the usual suspects, right? JC Penney or Sears, to the extent that they still have stores, or Macy's, Dillard's, and so forth. So it's just something to watch as the holidays go on. A couple of other retail stories that we've been following. This is another very interesting one. The owners of a South Texas mall, and this would be the Shops at Rio Grande. It's a regional mall in Edinburgh, Texas. Not huge. It backs a $30 million CMBS loan. It has JCPenney as its top collateral tenant. The collateral has about 460,000 square feet. It was built in 2008. But the operator of the mall is looking to sue Simon Property Group for anti-competitive practices. And it kind of makes sense. It's probably something that we should have thought of ourselves, that this is going to become a problem over time, but we never really thought of it. And that is, now that Simon and Brookfield have acquired JCPenney, how do you operate at arm's length with other mall operators in determining whether JCPenney should stay open in a certain market, right? And, in this particular case, the owners of the Shops at Rio Grande, are raising this issue, right? What's going to happen to their JCPenney now that it's owned by some of their competitors? And it'll be interesting to see if through the court process, Simon and Brookfield get some kind of scrutiny over this, and the other operators get some kind of protection, or if the gloves come off and it's really kind of every man for himself or woman.
What's the old vertical integration thing that you talk about in what do you call it, in ninth grade economics?
Antitrust violations, is that what you're talking about?
Yeah, well, it's like when people say they should go after Amazon for antitrust, and the problem is that they're getting there, but they're not really vertical. They don't own every layer from top to bottom, but they tend to just own a piece of everything very wide, right? I'm not really explaining this very well, but the idea of the property owner also owning the tenant is more of that vertical integration concept, right? Which does lead to potential antitrust. I don't know if they'll get anywhere with it, but it does kind of make sense.
The antitrust violations of this property owner are usually limited to those times when my wife asked me to take out the garbage or move the laundry along, and I failed to do so, leading to a real lack of trust in my ability to follow simple directions. Another retail story that we found this week, people are always asking this question. We get reporters all the time. We have clients asking, what are you seeing in the mall space for alternative uses, right? There's always been this thesis, which sometimes comes true, but it never comes true in any kind of large bulk, that these malls are going to be repurposed for call centers, community colleges, distribution centers, maybe multifamily housing. The only thing that has come through in any kind of material way is NAMDAR coming through and buying these things and just running them on a cheaper basis as malls, right? That's the only model that you've seen tried over and over and again. But in this particular story that came out, this was written up by the National Business Journal. Let's see if I can see the writer here. Adam Schichko, S-I-C-H-K-O, if I pronounce that properly. He pointed out that Bridgestone Americas had become one of the early adopters of taking mall space as an office. they had about 75,000 square feet of operations space in a old Sears store in Antioch, Tennessee, at the Global Mall at the Crossings. And now, because of work from home, Bridgestone is going to close that operation and let people work from home. They have 400 employees there. So just when there is a success story of alternative use for mall space, the rug gets pulled out of the owner once again, and that space will be vacant all over.
I mean, if it's a halfway decent mall, or like, I guess, aesthetically pleasing, it wouldn't be the worst place in the world to work, especially if they did still keep the Starbucks and the Annie Ann's and the other things in there. You know, to be able to walk out of the office. I mean, I guess that's what Manhattan is, but if you're in the suburbs, like walk out of the office and then look down and throw a quarter into the wishing pond, or, you know, go down and sit on Santa's lap or whatever it may be. Like, that's not the worst thing in the world. It reminds me, a couple Thanksgivings ago, I was down in Jersey and we went to the old Bell Labs building, and Bell Labs was part of what, AT&T back in the day, or AT&T, Bell Labs became AT&T later. And that's where they invented, you know, the telephone and all these other crazy inventions during the 1900s. And it was this massive, massive building, but it was kind of in a rectangle around the outside, and inside they had this huge kind of quadrangle covered in glass and everything else. And it was kind of cool. I mean, if you had an office, you can come out of the office and look down and see, you know, all over the place. So anyway, the moral of that story is I wouldn't mind working in a nice mall office, especially if it was closer to home. If that turns into like the satellite office in this work from home world, I would sign up for that.
I could see you chasing tweens out of the corridor after
on
3
my
o'clock.
Segway.
You know, school gets out, and you know a racket's being made, and you run out of you know, your cubicle, and you start chasing these miscreants, you know, out of the mall and on your Segway. I could see you doing that.
I'm trying to do my spreadsheets. Get out of here, you dang kids.
Get off my lawn. We do have one more mall story. This is kind of an early shout out. Steel City Dave wrote to us and said, over Thanksgiving, he had his kids watch the Blues Brothers, and they said they were riveted. And one of the scenes is the famous chase scene through the mall. I think it was the Dixie Mall. And he said, he looked it up and said that the mall had been shuttered, and that the Blues Brothers had acquired it for the sole purpose of trashing it for the movie. And he said, you know, maybe times are ripe for a Blues Brothers remake, since there'll be all these malls that will be empty, that, you know, some movie producer can come in and just recreate that famous scene. Or maybe some wealthy hedge fund guys will do it just for sport.
I've always said I just want to do a giant laser tag game in one of these old abandoned malls, but I'm probably not going to pay more than like 15 or 20 bucks for that.
You may be able to do that. So before we turn to office, we got a fist shake and a fist pump. Fist shake, more bad news for malls with theaters. Apparently, Warner Brothers is going to be releasing all their 2021 films on HBO Max and movie theaters simultaneously, taking away the exclusivity that theater chains have enjoyed. That's a bummer.
I don't really know how I feel about I remember, what was it called? Windowing, right? Where you release things in different channels over time to try and squeeze as much juice out of the lemon as possible. I mean, this makes sense because to HBO or Warner Brothers, who owns HBO, they would rather have everybody sign up for 10 or 15 bucks a month for their service than worry about trying to get them into the theater once or twice a year, right? It's probably going to work out better for them, but it's terrible for the theater chains. I mean, I grew up going to the movies, you know, every weekend, and I still cannot wait to get back and, you know, sit there and get a giant bucket of popcorn and a giant soda and just, you know, settle in for a 2.5 hour movie. But this can't be good for the AMCs of the world. And again, these were the types of retailers or, you know, retail tenants that for the last 7 years, we've been saying you need restaurants, you need movie theaters, you need, wine and paint places. You need things that are experiences to drive people to go places. And now even that's out the window. So it's not looking so great for kind of any enclosed malls at this point.
We talked about, I started the podcast with this, that, talking about our predictions for 6 months hence and where we're going to be on this, you really get the light at the end of the tunnel right now for the hotel guy, right? If you've held on this far and this long, what's another 4 months, right? If we can get this vaccine out there, we might make a go of this if we can get back to 85% of what we were by April. But in the mall space, it's hard to see, the lower half of these malls really kind of coming out of this without a couple of middle-aged guys in a police car driving through them.
Yeah, I think we shouldn't be so dour, because I think when we're talking like this, we're talking about that bottom quartile, right? Or the bottom 20% or whatever it may be of, the second nicest mall or the third nicest mall in an area. There's still going to always, I believe anyway, there's still always going to be the Westchester Mall and Tyson's Galleria and those types of places, because people want to go and, buy their, go to Torno and buy their fancy watch, or go to Victoria's Secret or whatever other kind of luxury place you can think of. I don't know if Victoria's Secret's really luxury anymore. But it's really those, secondary, tertiary malls that we think are going to really, really struggle. They're already really struggling, but will continue to.
As you talk about, fashionable outerwear, we should mention that our Trepp Wire podcast shirts and hats have come in, and we're eager to start giving them away to our listeners. So, maybe to the first, let's say 10. Do we have 10, Keegan? He gives us a thumbs up. 10, 10 guys that either want to email us or ping us on Twitter. Of course, you'll have to send us your mailing address. We'll send you out a Trepp podcast shirt that, can you either wear it proudly around your neighborhood or make it a stocking stuffer for your kids. I'm sure they'll love it.
All the nerds will love it. One more note, a fist pump. The Wythe Hotel, you were talking about hotels in Williamsburg, which is in Keegan's neck of the woods, has created a totally private restaurant experience. If you're looking for a Christmas idea, every room on the hotel's second floor has been converted into a dining room. And for $100 a head, diners can have the entire night to enjoy French food and drinks. That is creative.
$100 a head, includes the food and the drinks?
I think you'll have to make an appointment and find out.
Because if it does, that's not a bad deal at all. I'd pay almost anything to eat something other than at my own kitchen table.
Eat out. Yeah, exactly. So let's turn to office. Workers have definitely retreated back to their home offices in the last couple of weeks, and the overall demand for office space continues to be hit. So we saw a number of stories about that.
Yeah. Our friend Peter Grant at the Wall Street Journal put out another damning article on the return to work numbers. Overall, I'll just quote a few numbers here and then let Manus kind of jump in. But overall, and this is from Castle Systems, which is a security company for buildings. So it's a sampling, right? It's not every building, but in the depths in March 25th, kind of April, actually kind of mid-April was the depths of this number, which was about 15% of their normal amount of workers were swiping into office buildings. It got back up to almost 27%, and this is across the country. And now in the last kind of 3 or 4 weeks, we're back down to 17.6%. So, still under a quarter of the normal number of people who are in. Now, in New York City, the numbers are not so surprisingly worse. If I could just bring it up here. So we're at 15.9% in New York City, which is lower than the national average. A couple other places that are doing better, places like, again, here we go, Fort Worth, Dallas, Fort Worth region had 40% of its workers back as the benefit of good. This is from the article. Texas has the benefit of good weather, car commuting, and a culture that has been more resistant to shutdowns than those in states such as New York and California. So we had this kind of slow increase in the number. And if you can see it on the chart, kind of very slowly increasing month over month. And now we have another dip. So I don't see when we're going to get everybody back. I mean, we really need a lot of leadership and, some courage and some vaccines, to get really kind of out there.
This vaccine is everything. We talked last week about, hopefully that this would give us, instead of negative side effects, right, low-grade fever and body aches, there would be, some, rare positive side effects from taking the thing. And we did have another shout out from CO, who said maybe it will turn us into crime fighters. Like it would just, just like Spider-Man got the, the bite and it turned him into, a superhero, that maybe the positive side effect would allow us to go out and fight crime. Thank you, CO.
You get a spidey sense and maybe, as Joe mentioned, an ultra sense of smell instead of a loss of smell.
Right. Right.
In any event, yeah, it was a very big week for what I call micro stories in the office space. Really, kind of headline makers that will impact some communities considerably. And I'll run through them one by one. We've addressed them either all in Treppwire, or we will in the coming days. One of the headlines was Hewlett Packard is going to move their enterprise offices from Silicon Valley to the Houston area. When the story first broke, we were hopeful that HPE would be taking some of the excess space that's been shed by some of the oil and gas operations in that area. We know there's an awful lot of vacancy and a ton of sublet space available in Houston, but sadly for that market, it's going to go by the way of a new construction. It's going to be called City Place at Springwoods Village, which will open up in the spring of 2022. So they'll be leaving the San Jose market. Interestingly, they're going to keep their headquarters office there. Their headquarters will be moving, but they'll be keeping the physical space, and they're going to be bringing in a lot of their affiliate companies that are around the Bay Area and elsewhere in California into that San Jose location. There is one sizable CMBS loan that has single tenant exposure to one of their subsidiaries, Nimble Storage, in San Jose. That firm has a lease that ends in October 2021, about 165,000 square feet. They're expected to move on from that space and take on some of the old HPE space elsewhere in San Jose. So that could add some stress to a 2018 loan of about $98 million. So that particular loan also has a single tenant property in St. Louis that's occupied solely by Mallinckrodt, which is, we've reported on them before, the firm that has some legal liability on the opioid side. So that is one loan to watch, a kind of a micro story of another firm moving from, joining Schwab in moving from California to the Texas area. Another big story which touches CMBS, T. Rowe Price announced that it will be moving its Pratt Street location in downtown Baltimore in the Inner Harbor area to a new project in Harbor Point. This also potentially has impact for the CMBS market. There's a $110 million loan that backs two 2016 deals, a 660,000 square foot office. T. Rowe Price is the biggest tenant in that building with about 71% of the square footage. servicer data shows that lease ending in 2027, but prospectus footnotes make it clear that that lease can be terminated on 18 months of notice with a $20 million lease termination fee. So it looks like T. Rowe Price will leave a big vacancy in the inner harbor space of Baltimore, and that's a big loan to watch as well. And lastly, we love this story. This is hopefully a happy ending story. When we broke the news back in May that Pier 1, we didn't break the news, but we reported that Pier 1 was headed towards liquidation, the retailer. We noted where all the Pier 1 retail operations existed behind CMBS, but we did note that they had a big office in Fort Worth that was likely a potential source of concern for CMBS investors. It's a $55 million loan. The collateral's in Fort Worth. Pier 1 is the largest tenant by far, almost 88% of the space. As we know, they're liquidating. In fact, the name of the road that holds the building has been renamed. The loan itself hasn't paid since August. It's been working through the foreclosure process, but wait for it, the city of Fort Worth is going to buy the building and make it the city's new city hall. They were planning to invest up to $200 million to buy or to build their own new city hall. This is now going to be purchased, it appears, by the city to use for its city hall. And so this may be a case of turning a cow's ear into silk for CMBS investors. The loan backs two CMBX 12 deals from that year. So, you know, a potentially great outcome for what seemed to be a problem on its way.
A lot of Fort Worth today. I don't think we've ever mentioned Fort Worth so much in one podcast.
We may have to do a road trip. You know, we never did that Route 66, but somewhere down the road, there's a road trip in our future. Maybe you just, you know, hop in the car and do the power drive with some George Strait.
Well, if you guys want to come over and watch, you know, the new Wonder Woman or the new Star Wars, whenever that comes out in the basement here, you're more than welcome. Hit us up at podcast@trepp.com. I'll only be charging a $750 at the door.
How does that tie into the road trip? Like, you're talking people against joining us on the road for?
I'm telling people
George
to
Strait?
take a road trip up to the northern nether regions of Westchester County.
Why?
And we can enjoy
It's
a movie
cold.
together.
What are you serving and who else are you inviting?
Very lukewarm tap water, and anyone who takes us up on the t-shirt offer.
Wow.
Well, this reminds me, or, you know, I was thinking about the t-shirt thing and the hat thing, maybe the start of something bigger. Like, this should not be the end of the road. Like, we should start thinking about, you know, maybe our own line of flavored iced teas.
Merch.
Right? The Trepp podcasts, flavored iced teas, or maybe, you know, a series of books for young adults about the perils of commercial real estate.
How about a Manus bobblehead?
Oh
Where,
my
you know,
goodness.
you can, you know, what can go wrong when you go to the mall with your friends late at night and a power outage hits? You know, I think there's endless possibilities to, you know, to make, you know, sideways penetration, you know, maybe even for profit.
Complimentary services, aka merch. We're working on it.
I'll have to think about that. We have some deals of the week.
Yes, let me flip my page over
Music.
Did deal of the week.
So hopefully I can read my handwriting. First deal of the week came from the publication Commercial Property Executive. We had a similar story about this a week or two ago about a Publix anchored property getting sold. In this case, it's Osceola Village in Kissimmee, Florida, 123,000 square foot property. The seller was Glenborough LLC. The buyer was East Coast Acquisitions. Brad Peterson Whitaker Leonard Tomasola of JLL repped the seller. So it's good to see more demand for retail. Sadly, it always seems to come in the form of only grocery anchored. We'd like to see more stuff come in the form of, small shopping malls and other things. But that's one of our deals of the week. The other one is also similar to a story we told in the last few weeks. In this case, the property is 28-40 West 23rd Street. This is a story that was reported by the Commercial Observer. Let me see if I can figure out who wrote this story. If I can, I'll say it. I don't see it off the top of my head. Oh, Lois Weiss, formerly of the New York Post, a longtime friend of Trepp. So in this case, the property is a 571,000 square foot mixed use property, kind of lower midtown, kind of like the NYU area, you would call it. Home Depot has 21% of the square footage on a lease that was to end in early 2024. The retailer has extended for 15 more years. Another great sign for street level retail in New York. Previously, they had done the same on 61st Street, where they were taking over from I think a Bed Bath & Beyond, if I'm not mistaken. So Home Depot doubling down on their presence in New York City. That property backs a $140 million loan, which makes up almost 14% of a 2014 deal. I believe that's a CMBS 8 deal. Andrew Roos, Michael Cohen, and Mac Roos of Colliers represented Williams Equities, which owns the building. And Peter Ripka of Ripco repped Home Depot. So congratulations to all of them for getting that deal done and for making a bet on the Big Apple. We like that.
It always strikes me as odd having like a Home Depot in Manhattan. I think of Home Depot as that huge, 1,000-car parking lot, huge up and down, high ceilings, concrete floors, the whole thing. And that doesn't really jive with my average perception of your Manhattan apartment that's 400 square feet. Like, what do you buy at Home Depot for your 400 square foot studio apartment other than like, I guess, a toilet seat or, I don't know, an Allen wrench?
The thing that I would always buy at a hardware store in Manhattan as needed back in the day, and I hope the statute of limitations is over for this, and I hate to pollute the minds of our listeners to have them think that I am a reprobate. I had good reasons for doing this, but I would go and buy, I see Keegan laughing in the background. I would buy a wire cutter and a crimper so that I could take the cable wire that was running through my apartment into the guy's apartment right above me and watch cable television. And I didn't like that. I did feel like it was stealing. However, it would only come after 3 calls to Cablevision of New York, in which they had told me they would be there between 8 a.m. and 5 p.m. on a Wednesday. And
They didn't tell you which Wednesday.
Well, I would take the day off and I would sit there all day without television to watch because I didn't have any cable at that point, waiting for them. And 5 o'clock would roll around, and then you'd have to call them. You'd wait on hold for 45 minutes, and they say, "Oh, we're not going to get there today." So by the third time, I would go out and get the crimper. The thing was always just staring at you, right? That wire. And, I'd say, all right, the time has come. You'd cut it, you'd crimp it, you'd split it. And then you and your neighbor upstairs would watch slightly fuzzy Monday Night Football for the next 12 months until the lease was up.
James Dolan, if you're listening, I hope you're not offended.
It was Michael Douglas in Falling Down.
That wasn't quite that bad.
It's like Breaking Bad, It's like you're a good guy at heart. You're just trying to get some cable TV.
And so we have some shout outs this week. Jan F. commented on our recent hotel report, and he had an interesting observation, which we wanted to share with our listeners.
Yeah, so Jan asked us about our hotel report, which we put out, which actually showed the highest delinquency rate in the limited service hotel category. And on his side of the world, the data that he's looking at, he actually sees limited service hotels performing, I wouldn't say better, but I would say less bad than the full service and luxury hotel world. And that's in terms of RevPAR, revenue per available room. And he kind of just was asking, why is there a mismatch here? And, there is a difference between the performance of a loan and the performance of a property. And I don't know if this is true or not, but my gut instinct tells me kind of two things. One is that on Jan's side, he has much more granular kind of subtype categorizations. So, it may be an apples to oranges scenario here, but the other side of it is my assumption maybe that owners of limited service hotels are much less likely to come out of pocket to cover debt service shortfalls to keep their properties current versus, if you own the Waldorf, that's the bad example. But if you own the Plaza Hotel or if you own a luxury hotel, you might have bigger pockets to cover debt service shortfalls, and you might have more kind of motivation to hold on to the property.
It's also possible that we've never looked into this. It's worthy of looking into, that they have bigger FF&E reserves, maybe proportional to the loan size. Bigger trophy properties have more in reserve to do it than the kind of the roadside guy.
Right.
Maybe he's a little bit more shoestringy. And so some of these bigger guys had bigger sources of funds to tap. I don't know this for sure. I'm just kind of wondering if that's the case. And would be an interesting thing for us to look into, because we do get reserve data in our servicer reports. So it is something that we could certainly peek into.
That does make sense.
And we had Rick G asking us how we see ESG factors getting incorporated into our data in the future. And we actually have an answer for that.
Yeah, so we already have some E stuff, no S or G just yet, but we actually have some environmental data on our platform at this point. It comes from a sister company called RMS, environmental risk scores, revenue kind of disruption measures and things like that, climate risk scores. So we've mapped all of those to all of our properties, and we've actually had a few CMBS clients express interest in that as well, because we do see the tide kind of moving in that direction in terms of, it all comes down to the investor pool in the end, and the investors are starting to ask about this, right? They're starting to ask about how are big asset managers, fund managers, pension funds investing, or at least understanding their ESG impacts. CMBS is not immune to that. So we're doing our best to try and figure out exactly how to tackle that. But, for Rick, we'll send you an email and talk to you a little bit more about that.
I hope I didn't downgrade Trepp's G score with my cable TV store. I hope that our governance doesn't take a bite for my youthful indulgences.
We'll find out. And last shout out for me is Vivian W, who Keegan, she loves the timestamp because it allows her to go back and listen to certain sections that she is interested in reviewing. So
she skips all the boring stuff and goes to the fun, Manus digressions.
This is a season of giving. I was thinking we should auction off a lunch with Keegan. We kind of like one of those Warren Buffett things where he'll take you to
Wyeth Hotel.
We're Smith and Walensky. That's usually where Warren Buffett takes the winner. Somebody will bid $3 million to pick his brain over steaks and chops for 2 hours at Smith and Walensky. We should do the same with Keegan and see. Keegan, how's your investing track record?
I would say excellent. I'm not gonna pump anything right now, but
you'll have to subscribe to his newsletter to know what he's investing in.
Yeah, exactly.
Do you think we can get $50,000 for a lunch with Keegan? Donate it to the Towers to Tunnels Foundation or something like that?
Donate it to the Keegan St. Ange Foundation. Let's be real here, guys. All right.
Exactly.
Yes, please.
So quickly turning to corporate CLOs, our analyst Jody Yadoff published a piece that looked at composite documentation scores, and it provided an aggregate view of risk using our newly integrated capability that uses Fitch's covenant review. And it's a pretty insightful report. You should look it up on Trepp.com, but very, very high level. She did both a assets under management analysis and an industry analysis to show what the scores looked like broken down.
Yeah. So just to do a quick, this is not really an educational segment, but in the CLO universe, the loans that are acting as collateral to these securitizations all have differing levels of, let's call, legal protections or covenants, basically they're called. And that's why you hear, and these are things that, advance more cash to the lender if the borrower falls below some sort of trigger, or there's more recourse to the borrower, or whatever it may be, right? And there's these things called, this big kind of concept called cov-lite loans, so covenant-lite loans. And that's when, lenders are competing to originate loans, and they will loosen or remove some of these covenants in order to get the business. And there is varying kind of opinions about the performance of these types of loans, and if lighter covenants will lead to higher default rates, or if lighter covenants will give borrowers more flexibility in order to kind of push through and not default. But there's no like great measure of this, right? There's not a number in the data set that you can look at to figure out, is this a cov-lite loan, is it not? So this kind of covenant review is really a lot of very heavy lifting in terms of reading loan documents and kind of deal structure documents and things like that to assign a score to all of these loans. So it's an interesting and very valuable tool. And I applaud the kind of forethought of going through all of that effort to do and come up with those scores.
Yeah, it's not an idle speculation that this could become a problem. We've seen litigation a couple times this year where owners of term loans to certain companies have watched the companies kind of transfer intellectual property away from the company itself and put it into a separate silo. I wish I could remember off the top of my head which companies this pertained to.
Is this Hudson's Bay?
Well, that's on the CMBS side. That's not the one that I was really thinking of, but it is kind of a similar type of story to that one, where there's kind of concern that they have, shifted around collateral from under the special servicer's purview. But there were a couple, I think it was in the retail space, transferring intellectual property away from the core assets of a firm, but I'd have to look it up again. So it is something that is in the news these days. It is somewhat timely. It's certainly of interest to CLO investors. Going forward, earlier today, we compared bank CRE loans to CMBS loans. It would be interesting as a future endeavor to compare delinquency rates on bank C&I loans to distressed loans in the CLO space and see if there's any correlation between those two. Not to give Jody any more
She'll love that
homework.
idea. Yeah, she'll love that.
Yes.
So the Rockefeller Center Christmas tree, which we've talked about before here, Manus, and you weren't very nice to it, actually. It was lit up Wednesday, and it looked pretty much like it usually does, except it didn't have the normal crowd. So I thought it would be interesting to point out, especially this year, that the first tree was put up in 1931 when workers at the Rockefeller construction site put their money together and got a 20-foot tree because they were thankful to have jobs during the Great Depression. And by the way, they decorated it with handmade ornaments, tin cans, and garland.
I'll never forget that picture. It was in many offices in Midtown of the 6 or 7 guys sitting on the steel beam having lunch, which looks like it's about 60 stories up. And if I'm not mistaken, the building itself was rock center going up. And you actually see one guy at the end of the line, and none of them seem tethered to anything. They're just sitting on a big beam eating lunch, thousands of feet up in the sky, or 1,000 feet up in the sky. And there's one guy with a flask, at the end. If you look very closely at it, there's one guy at the flask, and that picture always terrified me.
Yeah, if you're actually in the Rockefeller Center corridors, below all the different buildings, that's where we, when Keegan and I go for a walk to go get coffee or something, they have all the pictures of them building Rockefeller Center, including that one, but a bunch of other ones where they have the 100-year-old riveter and, all the crazy tools that they used back then. And just to think that, back then to build something like that, they had hundreds and hundreds of workers on site. And nowadays, you see one of these buildings and there's like 4 guys there because it's all been kind of replaced by technology. But yeah, I mean, I was never a big Rockefeller Center tree guy, probably because I grew up kind of in and around the city, but also because when it was Christmas time at work and you had to catch that 6:22 train and you were just sending that last email at 6:11, and you knew like, okay, I can make this train. And then you got outside and realized, oh, I'm screwed, because there was throngs and throngs of people between you and Grand Central. And you had to turn into like Jerome Bettis to make the train. So I was always happy to see that. I mean, I love Christmas and everything, but I was always happy to see that tree go down after Christmas season.
Oh, bah humbug. Well, with that, we'll close. Thanks to our producer, Keegan St. Ange. May join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question, want a t-shirt, or just want to send us an email, send it to podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.